Bitcoin broke below 70,000, liquidations exploded, and yet institution didn't leave. The contradiction is the entire story today. Welcome back to Black Room Trade. We're here in Paris at the second stop of the week's AI War Europe tour. Now the weather and the city is absolutely beautiful, but today we're going to talk about what actually broke, what quietly held, and why this move behaved very differently from a panic. Now let's anchor this in a snapshot. Bitcoin sold off sharply, triggered over 262 million in liquidations in the past 24 hours, with longs accounting for roughly 129 million. Open interest fell to about 660,000 Bitcoin, a sign of leverage leaving the system instead of rebuilding. Funding rates across major venues turned negative, meaning the traders were paying to stay short, a sign of sentiments flipped fast. Now here's the contrast. Spot Bitcoin ETFs saw a net daily inflow of roughly 149 million, adding about 2,060 Bitcoin even as prices were under pressure. Now the total ETF assets sit near 99.5 billion and daily trading volume was over 5.2 billion. When you put this together, this looks like a market where leverage was flushed aggressively while spot demand stayed present, meaning a fragile market mechanically clearing risk, not one being abandoned. Now let's start with the hot cluster, the liquidation flush. Bitcoin move below 70,000 wasn't slow selling, it was forced. And when leveraged traders can't meet margin requirements, exchanges automatically close positions. Now that selling has nothing to do with belief or fundamentals, it's mechanical. Now if this was forced selling, then who was on the other side? And here's why this matters. Before this, leverage had been building, funding was positive, and many traders were positioned the same way. Mechanically, liquidations event tend to do one thing. They reduce leverage density, and that usually makes follow-up moves slower, not faster, because fewer traders are forced to react. But liquidations alone doesn't explain stability. Something still had to absorb supply, and that's where the contradiction shows up. Now Barrett notes that Bitcoin, Ethereum, and XRP all fell together, a classic risk off tape. Yet the selling didn't cascade endlessly. So when liquidation selling meets real spot demand, price often stop falling, not because buyers are confident, but because sellers are exhausted. Now let's talk about the quieter signal, miners. On February 8th, Bitcoin mining difficulty adjusted down by roughly 11%. Now why would the network make mining easier during a sell-off? Because difficulty doesn't move based on trader emotions. It adjusts when hash power drops or miners struggle to stay profitable. Now before this, higher difficulty assumes sustained participation, but now the network is acknowledging stress and adapting. Mechanically, lower difficulty can improve miner margins if price stabilizes, but that doesn't mean miners are healthy. It means the system is reacting after stress appears. Now the thing is that we do not have hash price or fees data here, so this is not a bullish or bearish claim. It's simply a structural adjustment. Now layer in something interesting. Morgan Stanley initiated or adjusted coverage on mining stocks, lifting names like TeraWulf and Cypher while staying cautious on MARA. So here's the thing. Why are we looking at miners when price literally just flushed? Now this suggests that institutions aren't reacting to candles. They're segmenting risk, and they're choosing where exposure makes sense, not whether crypto lives or dies. Now let's zoom out to the macro side. Nothing about macro actually broke. We're heading into the CPI and jobs data, and positioning often thins out ahead of uncertainty. So we do think that this is a cross-asset hesitation, not panic. Now this environment tends to amplify mechanical moves, exactly what liquidation does. Meanwhile, narrative pieces argue cash is losing purchasing power versus Bitcoin, but these are stories, not flows. And we have to understand that this matters because narrative often shows up after positioning changes, not before. So here's the thought that I'll leave you with. This wasn't a collapse, it was a cleanup. Now, leverage left, miner adjusted, institution didn't panic, and that doesn't tell us where price is going to go, but it tells us the type of market we're in now. We're currently in a market that reacts slower, punishes crowding faster, and rewards patience more than convictions. All right, that's what I have for you guys today. If you feel like I missed anything, feel free to drop a comment. And if you found this video helpful, make sure you drop a like and subscribe. I'll see you in the next one.